Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. As the market refocuses now on earnings and economic data after the Washington follies have subsided, what is the bull and bear case for the market? Well, we're going to see if our panelists can shed some light on that. Equity strategists Tracy Reinick and Todd Bunton, and chief equity strategist John Blank. We have John in the house here, which is always a pleasure. We don't get to see you that often here at the old video ranch, but
thanks, Jerry.
But we take advantage of the opportunity when you are here. Tracy, you say that the bull case is all about no taper.
That's right. Yeah, that's what's driven the market this whole year, and the story hasn't changed as long as the Fed is still staying on course with its QE, which it appears to be. Now, they've been bringing out some Fed officials recently, to talk about the taper, and they seem to indicate it all depends on the data, as they've always said. And so we're going to get the data, as you just mentioned, starting this week with the latest
housing data out as we speak
yes,
today.
And the unemployment
September jobs
delayed
on Tuesday. Some high-profile earnings reports coming out this week.
Right. So they'll all be looking at that, but from what they've all been saying, anything in October is off the table, given what we've just been through with the shutdown.
You say the shutdown delays taper
yes.
At least till next year?
I think so, yeah. I don't think they're going to do any kind of tapering in the middle of December when we're already going to have what looks to be like an iffy holiday shopping season. And then, Yellen will come in, and then we might get something. So yeah, as long as they're still doing QE, then stocks are going to like it.
All right, John, what do you think? Is it all about just QE and the delay of taper here on the bull side?
Well, Terry, I'm agreeing with Tracy, and I'll just elaborate a little more around that. The taper under their guidelines is 6.5% when you're stopping the taper. And we're going to get the report tomorrow, but it's printing 7.2 or 7.3 or 7.1. So we're a good year away, given we're losing 0.5% from that line. And there was news this morning that was somebody studied all the way back to the World War II period. Economies when the unemployment rate is above 6%. And that is the most favorable time for a stock market, and it was averaging 13.5% returns annually. When it's 6.5% or 6% and falling, above 6% and falling, like the situation we're in, is 16.5% on average. So the argument then was finished off with Tracy's point is when you have the Fed supporting it or at least staying on the sidelines, you're keeping interest rates out of the game. And to your point that you've made over the time is when earnings are pathetic, which you're right, but you also keep inflation out of the game, which keeps the taper on and keeps the Fed either on the sidelines or in the taper. So we've got the 6% unemployment rate. We've got the crummy earnings, which keeps the inflation rate, which keeps the Fed on. So I'm agreeing with Tracy, and I'm just being more elaborate in that respect.
Well, Todd actually made that point before the camera started rolling. But now we're going to let you make a new point here, Todd. You say that price momentum alone should carry this market higher through the end of the year.
Yeah, and it's basically, I don't want to say bubble behavior, but it's people chasing higher prices, right? And the better stocks do, the more the retail guy gets interested in it. And that there's still a lot of money sitting on the sidelines, even though we've been in a bull market for over 4 years now. But just the fact that people are seeing the S&P at record highs, and they're starting to get interested, and they look at their bonds, and those aren't starting to do well, and they're getting 0% in cash, and they're starting to think about getting back into the market because it's going higher. Of course, that's a terrible time to get in, but it's still not going to stop the retail person, and that could just drive us higher through the end of the year, even with somewhat soft fundamentals. I mean, the economy is doing okay. It's not gangbusters, as John alluded to. This earnings season's not very good. Earnings growth is flat. Right. But again, that just doesn't matter right now.
John, you say that volatility in the market, any that comes our way, is going to be related to surprises in earnings reports, not the fact that the market is just now getting all of this economic data that they were starved for during the lockout?
Right, I think so. My view is that the way we get screwed up here is one major sector, aka the banks, and we've seen some of it people start to sniff big problems, reserving that's getting hit, hiding something, loan losses that are showing up, or if we have something coming out of the taper in terms of leverage, right? That's somewhat, because the problem with the whole taper thing is you're leaving just a huge carry trade in the game somewhere in the system, and I guarantee we don't know where it is. I guarantee it's leveraged. And when the thing goes off, it'll go off, and we won't know it. So That's what I worry about, is that somebody who's really astute as an analyst within the financial sector, as it rises and carries the market forward, says, hold it, look at this. They're hiding something. There's leverage here or there's a bigger loss here. And that starts a tone and a change in the way the marketplace and takes that momentum off the table. Because Todd's right. It's the retail person that's driving this forward, but the way the market will tip is when the institutions get out of the way. And they will do that on something like a taper or something like a bad news and some
like a Lehman Brothers.
Right, exactly. And that, or some inside analyst report on Wall Street giving it all the big guys saying, look, we've got the right news on the story, and the banks are really problematic, get out before everybody else does. So the retail guy does get burned, but the institutions start the wheels turning on the way down.
I'm going to have Tracy throw out another point here for consideration, small caps. You've been keeping your eye on small caps. You say that they're key. Why?
They are, because that's where the risk is. And, I kept saying over the last couple of months, I'm watching the small caps, I'm watching them, and nothing but good times in the small caps. I mean,
Are they leading this rally?
Oh, yeah. I mean, they're way, if you look at the S&P 500 and then you look at the Russell 2000, I mean, it's far and away the better investment so far has been the Russell 2000. But that's where the risk is. That's where everybody's pouring in. If you're scared, if you're like, oh, the Fed may taper or this rally is over, you're not going into those. You're going into, dividend players and the big caps, which are really lagging right now. Mm-hmm. So the small caps is the key thing to me that this rally is going to keep going. I mean, they're on fire. They're not super bubble-ish just yet, but I am watching for that because they are starting to get a little bit ahead of themselves.
All right, I've got a growth and income strategist here. I've got a value strategist here. And John, you're the chief above both of them. So I'm going to throw this out here. I want to end with this. As this bull market matures, are growth stocks maybe going to begin to outperform the value stocks at some point?
I think from my survey that I get from the chief investment officers, they're agreeing with Tracy that growth stocks, and particularly small cap growth stocks, are the way to go right now.
Okay.
And that's the institutional money. So again, they push the bulk of the money in and out of these markets. And
so have they already started outperforming the value stocks?
yeah, they have, and they're going to keep going because the case that's on the table is the growth in the economy and some type of performance, albeit perceived. But if it's out in 2014 and is perceived out there and that story's bought, it's going to move forward, risk on, small cap growth, large cap growth, mid cap growth, stay with the program, buy the growth.
So that's already happened.
Yeah.
All right. Thank you all for that. And talking about stocks, these folks have their top picks for the week. That's in our next segment.